All right. Good morning, everyone. Thank you for taking a little bit of time out of your day here to join us as we tell you about IAMS Wealth Management and then more specifically the platform that we're going to have here. We're excited to tell you a little bit about what we've been working on, so it should be a worthwhile hour or so that we spend here today. First off, I'll introduce myself. I'm Charles Hiring. I'm a marketing coordinator and Chief Compliance Officer here at IAMS Wealth Management. Backing up a little bit, for those of you who may be unaware, insurance agency marketing began the process of setting up an RIA about 8 months ago at this point, and that's how IAMS Wealth Management came to be. So just a little background, by providing our agents a means to expand their business to the managed money side, we see it as a way to help expand their reach, increase their income, and better serve their clients. So with these goals in mind, IAMS Wealth Management was built accordingly. We've constructed a streamlined process, which will be touched on in one respect today as we talk about the investment platform more specifically. But this process is intended to maximize efficiency and fit in nicely with the insurance and annuity business you're already doing. Our plan is to take on the burdens of new business processing, portfolio construction, asset management, compliance, and billing, to provide the advisor with more time to really focus on what's important for their business, more specifically addressing clients' needs, gathering assets, and meeting with prospects. So today we're excited to be joined by Ryan Bohr. He's the CEO of Fusion Capital Management. Fusion is a strategic partner of ours, and they will be serving as, I guess, the operational arm of IAMS Wealth Management in a sense. They've already been a really valuable asset to our team here as we've built this out. And I know in the coming months that'll be even more apparent as we bring on more and more advisors. So we're really thrilled to have them on our side. Today, Ryan will be giving an overview of our investment platform. But before I hand the floor over to him, I just want to let everyone know that if you have questions, feel free to type them in. We'll be touching on those at the end of the webinar, and we'll get through as many as we can as time allows. And I know today it's just going to be a tip of the iceberg in regards to what we have to offer as an RIA here. So if you have any other questions that don't exactly even pertain to today's webinar, feel free to call into. I'm happy to help you in any way I can. Our number will be listed at the bottom of each slide, 888-255-7670. And again, feel free to call in anytime, and I'm happy to go a little bit more in depth on even other topics that we might not touch on today. So with that said, I won't hold the floor any longer. I'll pass it over to Ryan. Ryan, can you hear us okay?
I can. Thank you, Charles.
Yep.
Thank you, everyone, for taking time out of your day, as Charles said, to join us on this webcast. We're very excited about this partnership with IAMS Wealth Management. I've gotten to know the team over there over the last 8 months, 8 to 12 months, and have really enjoyed the time that I spent with them and even some of the IAMS advisors here recently too. So we're very excited about the partnership. We think there's a lot of synergies, and we think this will be a very successful relationship for really everybody involved. So thank you, Charles, and thank you everyone for taking some time. I wanted to just give a quick background on Fusion and how we operate and who we service and how we're going to benefit IAMS and ultimately all the advisors and our mutual clients. Fusion Capital Management was started back in 2011, January of 2011. I've been in the RIA business since before then, but I was working at a IMO and broke off from there and started Fusion Capital Management because there were just some operational issues and different things that we wanted to correct that we just weren't able to do so there. When we broke off, we spent literally the first year just building out processes, systems, and implementing various technologies to make our RIA more efficient. And along that path, as we were doing that, we were approached by another RIA to white label everything and provide back office support to them. That's really what started our institutional division. So most of our assets today are with a select number of groups that want us to provide back office and technology support to them, their advisors, and their mutual clients. And so that's really how our relationship came together with IAMS Wealth Management. We were actually referred to them, I believe, Charles, right? We were referred to you from one of your current advisors, is that correct?
Yep. One of our close advisors here, he gave a glowing recommendation, and everything he said has been true. So we're happy about that.
Yeah, well, perfect. Well, thank you. Yeah, and so that's how we've operated from inception. And a key point to make, and I think I highlighted on a slide later, the asset management business, especially everyone on the line, I'm guessing your primary business is insurance. We want to make this as easy and as efficient for you to continue to grow your insurance business, but complement it with this as well. We don't want this to take a whole lot of your time, and that's something that we've specialized in working with insurance producers and companies like IAMS. We haven't marketed at all. We've done everything word of mouth, and we've grown from zero in assets to, I couldn't tell you the exact number, it's got to be around 700 million or so AUA that we reference right now, with a pretty high growth curve coming up here over the next year. So enough about us. Let's talk about your platform. So Charles, if you wouldn't mind, let's go ahead to the investment platform slide.
Here's just our fun disclosure page. We have to state, kind of letting you know beforehand about our platform. And then here we go, Ryan, all yours.
All right, perfect. Thank you, Charles. Like Charles had said, the whole idea when we got together with Charles and the team there behind building this investment platform is we really wanted to make this an efficient and easy to use, yet if it needed to be a complex platform for the advisors and clients. And when I say if it needed to be, if you have an engineer or a doctor client or something like that, you know, sometimes the simple things don't necessarily work for them. So we have a very packaged, simple, easy, and efficient program to use. But if we need to unpack it a little bit to make it more complex for a client, we can easily do that. So all of that is taken into account as we go through this. So let's go ahead and go to the next slide here, please. When we were building it out, on top of that, we wanted to focus on suitable risk allocation. The IAMS Wealth Management risk-based profile system allocates clients' investment dollars to a core allocation, which meets a risk level that they're comfortable with and understand. We're going to focus on investment process, which ultimately will lead to what we believe will be good risk-adjusted performance. The IAMS Wealth Management profile system allocates to domestic equity and fixed income investments, and those underlying investments utilize rules-based engines, eliminating all emotion. It relies on historical data and algorithms, which can help invest when the odds are in our favor. You've eliminated two of the major issues there as to why people fail when it comes to investing, or maybe why they lag the indexes when it comes to investing, and that is, you know, eliminating emotion and having a rules-based engine. So, and then, like I said, I think we'll be able to achieve good, strong risk-adjusted performance utilizing a core suitable allocation and this data and algorithm to again achieve the good risk-adjusted performance. So let's go ahead and move on to the next slide, Charles. Not having a process leads to negative behaviors, and one thing negative behaviors have in common is that they can lead investors to deviate from a sound investment strategy that was narrowly tailored towards their goals, risk tolerance, and time horizon. The best way to ward off these negative behaviors is to employ a process that focuses on one's goals, risk tolerance, and is not reactive, again, reactive to short-term market conditions. The data shows that the average investor has not stayed invested for a long enough period of time to reap the rewards that the market can offer more disciplined investors. The data also shows that when investors react, they generally make the wrong decision. And I think most of us that have been in the business know that that is the case. They often buy high and sell low. And again, going back to what I said previously, we want to make sure we have a rules-based engine to eliminate the emotion so that we're not tempted, even as advisors, tempted to make some of those changes. So let's go ahead and look at the next slide. So let's talk a little bit about the core allocation structure. The whole investment platform is built around a core and satellite structure, which allows you to customize and tailor the investment strategy that's going to be implemented to the individual investor. Again, it's going to be extremely easy to implement. I'm going to show you how we do that. Every core portfolio at IAMS Wealth Management is going to consist of two portfolios. One is going to be the domestic equity portfolio. This is a momentum-based portfolio, and we'll get into some of the specifics on these a little bit later. But it's a momentum-based portfolio investing in various sectors of the domestic equity market. The other portfolio is a fixed income portfolio. It's an unconstrained fixed income portfolio, which is really trying to achieve positive growth over the index versus income. So they're both geared more towards growth. You take those two and you blend them together to make a core profile. So for instance, in this situation here, this example, That's core profile 6 is what we're calling it, which is 60% of the domestic equity strategy and 40% of the fixed income strategy. So if we take a look at the next slide, you'll see how this is all put together. We have 10 risk-based core allocations. So taking in what we just learned on the previous slide, here's how each one is built. And again, this is just the core portion of the portfolio, which is aimed at matching the risk tolerance of the individual client that you're working with. So profile 1 will have a 10% equity allocation and 90% fixed income allocation. And it goes down that line. So profile 4 will be 40% equity, 60% fixed income. Profile 8, 80% equity, 20% fixed income, and so on and so forth. And you can kind of see how the risk level goes from least aggressive to most aggressive, and the time horizon also coincides with that as well. It should be shorter term time horizon in profile 1 and longer term time horizon all the way out at profile 10. So if we take a look at the next slide, you're going to see how we can start to customize or some of the options that are available to customize your client's portfolios. So at the top we have 10 risk-based core allocations. So what will happen is you'll sit with a client, you'll go through a risk questionnaire, it'll tell you you scored X, and the recommended core allocation is 6. And now let's say you're sitting with a client and they say, yeah, that's great, I get that, I want to manage my risk and that makes a lot of sense to me, but you know, I really like real estate. I really want to have some investments or some additional investments in real estate. Is there something you can do for me, Mr. Advisor? Sure, you absolutely can. If you look below, there's 5 investment objective-based satellite allocations. So there's a safety allocation, which could either be your indexed annuity sale or another portfolio that's available at IAMS Wealth Management. You have an income play, which again could be an indexed annuity or one of the portfolios we have. Growth of capital, which is an individual stock strategy, and there could be some alternate ones there as well as we grow. There's an alternative diversification strategy, which would be options. So if someone wants to have some option strategy to hedge within their portfolio, that's available. And then the last one, which I already mentioned, is real estate. It's a public non-traded REIT with daily liquidity after year 1, so it's an attractive product. So back to my scenario there. Client wants to have some real estate to work with their core allocation. Let's go ahead and go to the next slide and I'll show you what it looks like. So what you've done is you've taken your core allocation, which is 60% domestic equity and 40% fixed income. So there's 2 separate portfolios there. You've added real estate, which could have, you know, an infinite number of investment holdings as far as the real estate positions in there, which then creates what you see there is a customized allocation for your client. It's diversified. There's very low overlap within the portfolio. In fact, this portfolio would have 0% overlap when it's fully allocated, which is important. It's one of those silent portfolio killers. And again, it's completely customized to what your client was looking for while managing the suitable risk level for that client. So again, simple process. Charles, is there anything you want to add that I overlooked in going through that?
No, I think you covered it pretty well, but I just would reiterate the simplicity of this. That's the whole goal in mind. So obviously you will start out with your core allocation. Some clients won't even need more than that. That might be all they need in their portfolio. But like Ryan's saying, if you run across anyone who might want something else or feels like they need to even diversify further, that's totally doable as well. It's really meant to be simple, yet able to handle whatever you might run across.
Yeah, that's a good point, Charles. And again, I want to reiterate, I was trying to give a little more detail, and it is simple as filling out a risk questionnaire, which ties and points you to one of those core allocations. Of all the advisors that we've worked with that use a similar system, I would say, Charles, probably 60% of them, if not more, just go into the core allocation and never add a satellite. So it's literally just answer questionnaire, point to the core allocation, and invest. So it is a very simple process. Usually when those core or satellite allocations come into play is when you have a higher net worth client or someone who's worked with a broker who's had some different investments in the past, and that's kind of where they get those ideas. But yeah, to reiterate that point, it is a very simple and easy to implement platform for advisors, and it's efficient for our mutual clients as well. So let's go ahead and dive into some of the underlying portfolios and kind of walk through how they work. Now, I'm not sure if anyone on the call has worked with momentum investing in the past, but momentum is the premier market anomaly and is above suspicion. Anyone who follows momentum knows Sam and French. There's some professors that have done a lot of research on it. And again, there's been extensive academic research on it. We see time and time again that momentum, if implemented correctly, can add good risk-adjusted returns to a client's portfolio. So let's go to the next slide and just talk a little bit about relative strength and what it is. A momentum investing technique compares the performance of a stock, ETF, or mutual fund to that of the overall market. So what we're doing is we're calculating which investments are the strongest performers compared to the overall market or index. And the idea behind this is that those are performing stronger are going to outperform the others. At the same time, if the markets turn, those, typically speaking, or theoretically speaking, are the last ones to fall. So, or they don't maybe fall as hard as the poor performers. And so it gives us some time to maneuver the portfolio as shifts in the market take place. So let's go ahead and look at the next slide. Excuse me. So like I mentioned earlier, and we're primarily talking about, for starting here, is the domestic equity. We use data and algorithms in these portfolios to make these decisions. There's not a human saying, I think utilities is going to outperform materials this month, and so let's invest here. It's all data-driven using algorithms. And so I'm going to walk through. We can get a little into the weeds here, but I'm going to just try and give you an idea of what we're doing so you know the rules that we're playing by, which in turn will help you when you're in front of clients. You'll know the rules, and you'll know what we're doing and how we're doing it so you can explain that. So there's 3 factors, sometimes 4 factors that we look at for each portfolio. And most of them are based off of 3-month returns, 20-day returns, as well as 20-day volatility. And the reason why we're looking at the 3-month returns and 20-day returns, again, we're trying to get a gauge on the momentum of the individual ETFs. And we like to look at the volatility because we want to make sure that that momentum isn't, really spiking at or extremely volatile, I guess is what I'm looking for, because the more volatile positions may not have, a trend behind that growth. So additionally, we also use a moving average on a lot of the strategies. Again, that kind of helps measure, is this a sustainable trend in this underlying position, or is this, one of those hot moments that it could have been caused by some algorithmic trading shop or who knows what. There's any number of reasons, but we try to, again, make sure and validate that there is a trend there for that underlying position. So let's go ahead and go to the next slide here, and I'll show you how we do this on a monthly basis. So each ETF is ranked for the factors that I just mentioned. So here's an example. We have 3 ETFs. We have AAA, BBB, and CCC. And we're looking at the 3-month return, the 20-day return, and the 20-day volatility. So just for this presentation, let's look at AAA on that top chart there, top right chart. You can see the 3-month return was 7%, the 20-day return was 17%, and the 20-day volatility was 16%. So next thing we're going to do is rank that compared to the other ETFs. So you can see the 3-month return rank, it was the number 2 ETF. The 20-day rank, it was the number 1 ETF. And then the 20-day volatility, it was the number 2 ETF. Now we take this a step further, and we'll show you this on the next slide here. We then weight each of those factors. So in this example, we're looking at the factor that has the most weighting is the 3-month returns. We're looking and weighting 40% of the allocation to the 3-month returns, 30% to the 20-day returns, and 30% to the 20-day volatility. Now, I want to reiterate that this is an example. Those are not our actual percentages or weightings. We generally do it a little bit differently. We're more heavily weighted on the volatility, meaning that we're able to manage the downside a little bit better, being that clients are more loss averse, versus risk averse. They're more worried about when they lose money versus make a lot. So we actually weight more towards the volatility. But again, in this case, you saw the previous example, 7%, 17%, and 16% for AAA. the rankings below. So what we're going to do now is go ahead and factor in those weightings. And how we do that is we take the weighting times the percentage, and then we get those rankings. So you'll see on the top, and this is a specific example of how the domestic equity portfolio ranked for a period of January 1st, 2016 through 3/31/2016, so the first quarter of 2016. It uses the domestic equity strategy. In this example, uses a 3-month return, a 20-day return, 20-day volatility, and it looks at a 5-month moving average. It holds the top 3 positions that pass all the screens, and SHI is utilized for the remaining allocations. So if only 2 qualify, then SHI will be allocated, and SHI is short-term treasuries. So it's, I believe it's, I can't remember exactly the time frame, but it's short-term treasuries, so it's very stable, not as volatile as some of the other fixed income products. So at the top here, how each position ranks. So these are all the different ETFs we use in the domestic equity strategy at IAMS Wealth Management. You see, let's look at IWF. Its 3-month return was negative 1.1%, 20-day return was 4.1%, and the 20-day volatility was 8.9%. That gave it the #1 ranking amongst all those positions. If you look at that bottom slide, that was the only one that was invested in the overall screen. The other 2 that were in the top 3, IWP and IWS, they did qualify. However, the 5-month moving average kicked them out. They were not above their 5-month moving average, so we weren't invested. Now, for all of you who followed investing in the first quarter of 2016, it was an extremely volatile quarter. I believe January was the worst January, I want to say, in history, and you know, the first quarter was not good overall, which most people thought would present a bad investing year for the markets, but it turned out to be slightly different than what they expected. So in this case, there was only 1 position that was invested, which was IWF. So the starting rate was 33.33%, and since those other 2 didn't meet their 5-month moving average, it was 66.67% invested in SHY. You can then see the performance for the period, 0.67% for IWF and 0.9% for SHI, which gave us a 0.83 gross return for the first quarter. So from a risk-adjusted return standpoint, that's great, but even from a pure performance standpoint, that's pretty good given how the markets did in that period. I think the next slide is going to illustrate some of those data points as well. Yeah, here we go. So for first quarter 2016, the strategy volatility was 5.8%, and if we look at SPY, which is just the S&P 500 ETF, it was 18.5%. So we reduced volatility by almost 69%. And then if you look at the gross performance data, we had a 0.83% gross return versus a 1.33% gross return on the SPY. So great risk-adjusted performance. We were able to stay out of a lot of that volatility, because usually when those periods occur, our clients get stressed, get emotional, and that's usually when bad decisions are made. So I would think that the strategy and the data behind it made a lot of sense for the first quarter. So let's go ahead and dive into some of the specifics on these portfolios so you can just get an understanding of what they look like and how they performed historically. And Charles, how are we doing on time?
Yeah, we are cruising right along at a good point here. So let's keep it up. Okay. I think it's good. You gave a good overview on just kind of how the whole process works. Now we'll kind of peel back the curtain a little bit and show what domestic equity and fixed income consists of. Okay,
perfect. Yeah, I'll try and breeze through this a little bit here so we can leave some time for questions. So let's go ahead and take a look at the domestic equity strategy. It's a domestic equity rotation strategy seeking to produce returns that are better than its respective index, which is the S&P 500. So let's go ahead and take a look at some of those specifics and how it works. We use domestic equity ETFs. We use iShares cap-weighted ETFs. The strategy will only hold the top three ETFs based on the screen for the period, and it's traded and rebalanced on a quarterly basis. So at the end of each quarter, we run our screen and we see which are the top three, and then we invest those. those holdings are to the right there. You can see now the data here is a back test, so you can see which strategies were held the most and the total contribution to the return. An interesting side note here is you look at IWO, that's the Russell 2000 Growth, it's a small cap growth ETF. It has not been utilized at all, and that's probably because the volatility is exceeding the volatility parameters, and so it's rating it a little bit lower on the scale. But overall, you can see where the returns have come from. So let's go ahead and take a look at the next slide, and I'll kind of go through the rules of the strategy, which we touched on briefly earlier. We look at 3-month returns, 20-day returns, 20-day volatility, 5-month moving average, and if fewer than 3 qualify, then shy is invested in the remainder. That's a typo there, I apologize. And it trades quarterly. So let's go ahead and show you some of the actual data of this. And this is next couple charts are pretty interesting. It shows you really how this reacts in various market cycles, and we're just going to look at 2016. So if you look at January, February, and March, you can see how each of these positions ranked, but anything that's blue and above that gray dotted line is what was invested in. Below the line, we don't invest in more than 3, but you could see which ones would have qualified if they're a shade of blue below that. So you can see in the first quarter, we weren't invested in anything except for IWF, which helped us eliminate, all the volatility in the first quarter. But if you look at everything thereafter, with the exception of November, which didn't apply to us, we were invested in the market for the whole time. And I'll show you what the backtested data looks like here in a second. So you can kind of see how it works and the advantages of using a momentum-based strategy. Let's go ahead and take a look at the next slide. I think this one's pretty powerful. What you're seeing here is a couple of things. Is the blue line kind of going through this chart is the S&P 500. And if you take a look at the orange area, that's when it's invested in a mid-cap allocation. The yellow is a small cap allocation. The gray is large cap allocation. And anytime you see blue, that light blue, it's a defensive allocation. So you can kind of see around 2000, everyone always wants to ask about 2008. You can see around the end of 07, this portfolio started to move defensive based on the momentum signals that we were getting. So throughout all of 2008 and then beginning of 2009, it was defensive, or would have been defensive based on all the data that we received. And we're able to give you the trade data if anyone's interested in that as well. And so you can kind of see in times of volatility, you see that defensive allocation picking up. So I think that's a pretty powerful chart. Let's go ahead and take a look at the next slide, and we can see some of the data that will kind of back up that chart. Now again, just want to reiterate, this is an algorithm. It's a database strategy, so this is back tested. This strategy was not around in 2003. That's the inception of the underlying ETFs. However, we feel pretty strongly about it, given that there is no human component to it. It's all data driven. So you can see on the right what the total gross returns would have been for this portfolio. We are working on some data sheets with IAMS Wealth Management that will show a net number on there as well, based on the fee structure that they're putting together. It's a very competitive fee structure, I might add. So you can see how this sleeve of those core portfolios would have performed over the years. I always like to look at a couple of different things. The performance is great, but I like to look at maximum drawdown because that's what clients feel when they're losing. And you can see a negative 15.6 versus a negative 55.2 for SPY. What's even more impressive here is winning periods and periods outperform the benchmark. It's almost like a batting average for baseball. So winning periods meaning how many quarters was it positive? So almost 81% of the time, this has been positive based on the gross backtest. And periods, meaning quarters that it outperformed the S&P 500, was almost 67% of the time. So again, strong data. I'm a data person. Some of you, if I've spoken to you in the past, that it won't shock you that I look at some of that stuff. I like to look at the data and make informed decisions, and those are pretty strong metrics to look at there. So let's go ahead and take a look at the next portion of the core lineup, which is the unconstrained fixed income. It seeks to achieve long-term positive returns in diverse market environments over full market cycles. And this invests in a broad spectrum of fixed income investments. Let's go ahead and take a look at what some of those investments are here. You can see now this strategy is a little bit different than the previous one. This actually uses a core and satellite makeup as well. The core investments are focused on basic core, what a core fixed income allocation would consist of, and then we have the more tactical component, which is the satellites down below. So the core will hold 2 of the 4 positions that are available, and then the satellite portion of it, which is where we're trying to get our performance or our outperformance, will hold up to 3 of the 16 available positions there. So let's go ahead and take the next slide. Look at the next slide, and I'll show you the rules that this strategy is using. The core looks at 3-month returns, 20-day returns, 20-day volatility, and a 3-month moving average. And again, if the top 2 positions are selected, if one of them isn't, or if both of them aren't, it's allocated to SHI, again, short-term treasuries. This one trades monthly. Both sleeves of this trade monthly versus quarterly on the domestic equity. The satellite uses the same 3 parameters up top. The percentage weightings are different. However, ETFs in the satellite, this is a little bit different. ETFs returned by the screener must be ranked above SHI, or basically performing better than short-term treasuries. Otherwise, we'll invest in treasuries. So if you have one of the top 3 that is the only one that's outperforming treasuries, that would be the only one that we invest in. And I believe we have a chart here next to show you what this looks like. Now, again, this is a very telling and interesting chart here, because if you follow fixed income throughout the year, you can remember and you can see how this correlates to how that performed throughout the year. So in January, let's just take a look at the core allocations. January, it wasn't allocated at all, none qualified due to the moving average, but then you can see for almost the rest of the year, the core had 2 positions allocated, with the exception of most of the fourth quarter. And again, that makes perfect sense given what the fixed income markets were and how they were behaving in the fourth quarter. And if you look at the satellites, most of them, it was mostly fully invested throughout the year, except for the end of the year, which, again, due to the markets, very few sectors of the fixed income market were outperforming the short-term treasuries because of volatility. And you can kind of see a number of the different positions that were utilized throughout the year. This can use leverage, or I should say a leveraged ETF in the portfolio, and it did use that in February, March, April, and then a little bit in July and August, which really played to the portfolio's benefit. And you'll see that on one of the slides coming up here. The next slide, it shows us what this looks like, again, as the market progresses. Same idea behind the domestic equity one. You can see the different asset classes. It's important to note here the defensive cash position is the dark gray. So at the beginning of the year, you can see a little bit of the defensive posture, and then it really went defensive towards the end of the year, towards the December 2016, where it's 100% defensive. Let's take a look at how this is done in using some of the data. You can see the total gross returns on the back test there on the right. Last year was a good year for this portfolio, and I mentioned the leverage. You can see how it really benefited the portfolio last year versus the aggregate ag bond index. It's not the benchmark is not SHI there. It's AGG. So it had about 6 points of outperformance on a gross basis on the benchmark. Again, looking at the drawdown, -7 versus -12.8. And then fixed income is arguably one of the more challenging places to invest, especially in the current market. So that's why we're so pleased with the strategy last year. But you can see the winning period, meaning months. Over that period, it won almost 70% of the time. And the period that performed the benchmark, meaning months to outperform the benchmark, was almost 56% of the time. So a strong portfolio, and again, the data behind it reinforces really what we're talking about. So I believe that's the last slide I have to go through. Charles, I'll open it up to you and see if there's any questions you want us to address.
Yeah, perfect. So yeah, I think you did a great job in a half-hour time frame, kind of giving a quick rundown on how everything works. Obviously, we don't expect everyone here to remember that off the top of your head, so we are recording this. So if you'd like to get a recorded version of this as well, feel free to reach out. I'm happy to pass that along to you. From there, we do have some questions we can move along to, and the first one, Ryan, I think is a great one for you. One listener chimed in and said, as an annuity salesman, I'm typically the safe money guy. How can I bring this into my practice and kind of move forward as, I guess, building out and widening your reach of assets you can touch?
Yeah, that's a great question. Thanks to whoever provided that. And Charles, we spent a little bit of time on this in the training we did down here in Dallas. When we go through training, we educate and walk through with advisors how they're currently positioning themselves in their practices and how to implement this into their insurance or index annuity practice. And so what I would say is this. Every advisor, whether you're just insurance-based or you're an asset management type of advisor, you're all focusing on one type of risk or another. And what we've always done and what we walk through with the advisors down here in Dallas is just reposition yourself as a risk manager or an expert of managing risk, because there is risk associated with every investment, including index annuities. It's just a different risk. And this way, you can easily implement the managed money into your practice and complement really what you're doing as as an insurance professional. Complement everything that you're doing there, and really offer a good, sound portfolio, meaning insurance as well as assets.
Yeah, I think that summed it up perfectly. So great job stating that. Moving on to another question we have, and this is a great one too. Someone asked, can we do this if we don't have a Series 6 or a 7? There's a couple different ways you can actually align yourself with an RIA. I guess the simplest and most frequent route is a Series 65 exam. So if you already have that, it's as simple as registering or moving over from a current RIA. Another method people typically use is using their designation as a way to waive the exam requirement. So if you're an existing CFP or CHFC, something along those lines, that can actually be used in place of the Series 65 exam as you register. So those are a couple ways you can get on board. If you have a Series 7 and 66 with a broker dealer, typically it's just as simple as registering again too, just going through the registration process. So there's more than one way you can align yourself with an RIA, but those are a couple different options. So if you have any specific questions regarding that, or how do I go about getting my 65 and aligning, go ahead and call in that number below. We do have a program in place to get that set up for you and get you on your track to hopping on board. So I'm more than happy to get you that information you need. Another question we have, and this one probably a good one for you, Ryan, and it's in regards to the momentum and relative strength investing. This question noted that the software seems to be chasing better returns. Isn't that too late? And just your comments on that.
Yeah, no, it's a good question. So it's definitely not chasing returns. So what it's doing is it's taking a look at two things that really are not return. I should say two things that don't focus on the highest returning ETF in the portfolio. One being the moving average. So if it's the hot ETF of last month, it doesn't necessarily mean that it's going to be in the portfolio that following month. And again, we look at 3-month returns. We have moving averages that are 3, 5, 8 months long. So there has to be an established trend for that underlying ETF to really qualify. So I would say no, it's not chasing. And then more importantly, the biggest weighting in most of these portfolios is the volatility measure. So I'd say it's almost I won't say it's complete opposite, but it's going for what technically is a safer play based on the data provided for those underlying investments. So normally, I would say, yeah, it could be chasing returns if the screens and the data was set up a little bit differently. But we were keeping in mind that we work with almost exclusively insurance professionals, and given that you sell, guaranteed products, we wanted to make sure that we had products that are available that, manage that drawdown risk as well. So I could see where it could be seen that way, but it definitely is not built that way. Does that make sense, Charles?
No, yeah, I think that's a good way to answer it, and it's a totally fair question too. So I'm glad that got brought up.
Yeah. Yep. Very good question.
Yeah. Another one, Ryan, here we have is something we've run into, asked by multiple people, so it's a frequent question we get. But if you run across a client who already has a portfolio, let's say, of certain stocks they're really partial to and they don't want to give up, but yet they still want to move over to the platform and maybe get some core allocation as well. How would something like that work?
Yeah, that's another very good question. What we would do in that situation is the way that IAMS is structured, it really allows advisors to go out and gather assets with their clients. So you could bring over those individual stocks. We could hold them in a portion of your portfolio, and then we could allocate the remainder of the portfolio to the core allocation or any of the other strategies as well. That being said, those are still invested, obviously, in the overall portfolio, so there's fees and stuff associated with that, but we can absolutely move those individual positions over and mark them as held as separate assets for those clients.
Yeah, so I think that's important to know that that's something that can be done. It kind of circles back to our whole idea of a simple platform that's able to do a lot of things. So that's really our goal here, and then that's just another way we try to make that possible.
And Charles, if I might add one thing to that too, a lot of folks that we work with, they bring all the positions over in kind to begin with, generally speaking, because it makes it easy to gather those assets, bring them over, and then allocate once the assets get here, so they're out of the previous advisor's control. So generally speaking, all the assets that come over to start are the assets they currently have, and then we just allocate from there. So it's a good asset gathering system to help grow sales on both sides of your business.
Yep, I would definitely agree. So with that, we do have several more questions here. A lot of them get into a lot more specifics. I kind of want to touch on more on an individual basis, which I'm happy to follow up on. But as far as things go here, we've run about 45 minutes, so I think it's a great place to tie it off here. But again, I do want to thank Ryan for taking some time to join us and tell you a little bit about our platform. He's a great partner we have, and we're excited to move forward here and get this thing rolling with him and his guys by our side. It should be a really beneficial relationship for us, for our advisors, and for, like Ryan said, our mutual clients. So it should be great. Again, to reiterate, for more information, I know we didn't touch on all of what you might want to know today. The platform is just the tip of the iceberg. So if there's anything you might want to know from a different area, feel free to call in. I know I'm repeating it a lot, but that number is at the bottom of the screen, 888-255-7670. Our team here is happy to answer any questions you might have. And if it's a question that might be better for someone like Ryan to answer, we can definitely be in contact with him too, just to make sure we get you an accurate answer too. So Ryan, do you have anything else to add before we tie things off here?
No, just appreciate everyone's time, and if you do have questions, just let us know, and we will help you to address those. And thank you again for the time, and thank you, Charles, and for the partnership. We're really excited, so thank you.
All right, well, that'll end today's webinar.